You are now listening to The Big Trade with Peter Pham, enlightening conversations for maximum market returns.
Meb, why don't you introduce yourself to the audience?
It's great to be here. Thank you. I am a little bit under the weather, so I apologize if my voice is a little scratchy. I am co-founder and CIO of Cambria Investment Management, which is a Los Angeles-based money manager. We do public ETFs. We have 5 now, 2 private hedge funds, and separate accounts. Been around since 2006, started managing money in 2007. And the focus is kind of across the board, but always quant-based, global macro, equities, and everything in between.
So, Meb, I hear you like to surf. Is that true?
Yes and no. I like to surf. Having grown up in Colorado, I have ski legs rather than ocean legs, so
Right.
I'm not very good. But I like to go out there and get tossed around. That's for sure.
So I heard this interesting analogy about like good surfers where they're going to look at waves and they're going to study them. They're not exactly going to try to like surf, but they're going to observe waves, understand the various different patterns in order for them to, catch the right kind of waves for them to have, I guess, what's called like a successful surf. Are there any analogies or parallels that you would connect between markets and surfing?
I'm sure there's plenty. But for me, it's kind of the opposite. I don't have very much of an ability to pick the waves, so I just get pounded on a regular basis. So if anything that I've learned, it's, if you don't know what you're doing, then you can't expect to have a magical outcome, which I think would apply to markets more than anything, right? If you just show up hoping you get lucky on your first wave and catch this beautiful 2-minute ride, and the next thing you know, you get punished and knocked down onto the reef. So lessons I learned are probably a little different than the one Kelly Slater would have learned, but I like it nonetheless.
You're right? Sometimes the retail investor is going to, say, speculate on a stock, do very well on it, but then they don't really understand how to surf, and then boom, they're going to get hit the next few times after, and that's what you call tuition money, basically, right?
That's right.
So, Meb, it would be great if you could explain how you got started into the industry. I know you have a very fascinating story and path. It would be great to get some insight on how you're using, social networks, websites, the whole distribution mechanism to communicate about your thoughts and your IP.
My background is a little atypical. I started out, my undergrad was in biotech and engineering, and I had done some graduate work as an undergrad and was kind of burnt out. So I had taken a year off before going back to get my PhD, and worked as a biotech equity analyst for a fund outside of DC, and then still going to school at Hopkins at night. And this was in the year 2000. So if you remember back to those markets, not only is it exciting from the sense of the 90s bull market and things starting to top out, but this is also when Celera, as well as the government, were sequencing the genome, which is all happening in that kind of Bethesda corridor. So it was an incredible time in markets, really interesting. And needless to say, after that year, I was kind of bitten by the bug and wasn't ready quite yet to go back to 6 years of grad school, which is my brother who went through his PhD program would describe as the short end of the spectrum. So, I said, all right, I'm going to maybe give this another year or two. This is too fascinating. So I started out, I hooked up with a quant futures group, started doing research, gravitating more and more away from the equity side of the business, more towards the global macro world. Did that in San Francisco and Lake Tahoe, although you could say I was probably skiing more than markets when I was in Tahoe. And then eventually moved down to start this company in 2006 and started managing money in 2007, like many small shops, I wasn't coming out of a Goldman or an SAC, and so we weren't seeding the business with 100 or 500 million, but really building it the traditional way for RIA, investment advisor, by scratch, friends and family. And one of the fortuitous things that happened for us, of course, was 2008, 2009, because our longest and oldest, probably most famous strategy is a very simple trend following strategy, which would have kept you out of most of the mess of 2008, 2009, would actually have been flat or slightly up in 2008. So more than anything, had a lucky beginning. And not only that, had published a paper, my one and only academic paper in a journal in 2007, detailing the process. So it was luck more than anything in the auspicious timing of here's a simple method that could keep you out of long bear markets. And then what happens? You have one of the monster bear markets of my lifetime, the next year. So it was good timing, but, kind of started the business, grew it from being small and not having any marketing people or sales people. We still only have 4 employees, although looking to expand. The way you get your research out there is, for me, has always been publishing. And the good news now is that medium is different than it was 15 years ago or 20 or 30 years ago. Almost everyone in my position either had to write a monthly market or quarterly market, annual market commentary like Buffett does,
right,
or publish more on the academic side, the white papers and journal articles. The journal articles, the problem with that is there's such a long lead time. I mean, it takes a year, if you're lucky, for it to get through the peer review process. And so after my first one, I said, look, this was nice. I can send it to my mom. I can be proud that I got published in my 20s. But, it was kind of funny when it came out online. I was never so excited, and I look it up and every day to see when it was available. And sure enough, they had messed up my name, and so had it as Melanie Faber. So not only got my name wrong, they got the gender opposite, but they fixed it for the print, which was good. But the nice thing is that with the internet and the way the world has evolved, that you could just throw papers up online on SSRN or any number of outlets and get the audience and feedback that you would have gotten through the peer review process much quicker and with 100x, 1,000x people reading it instead of just 1 or 2. And so that's actually helped. And then that's the way that I've kind of gone since, is publishing the papers online, publishing the books. We put 3 out, 1 traditional, same sort of thing. The traditional romance of publishing a book and having it in bookstores or the airport and, being able to send it to people. But then after that, did 2 self-published books and getting ready to publish our 4th probably next week, 2 weeks, if we can get the darn thing edited. So that was the really long-winded answer to your question, but it's been a kind of meandering road of how we've gotten where we are today.
Yeah, when I hear that story, it kind of relates a lot to like what I also experience. Very unconventional, from Canada, studying information systems and human behavior during the .com boom. You at the same time when you were getting interested with biotechnology, I was still trying to recoup from this whole .com crash and still trying to understand about it, and also trying to understand like how to utilize information, social networks, right, to communicate to an audience. So it seems very interesting that you took this path. And sometimes it's these kinds of people that are able to become, unconventional portfolio managers to some extent, rather than
and you actually find a lot of former scientists, quants, in our world, or people that have very atypical backgrounds. It's just not the biggest filter and funnel, right? That's the traditional business school or undergrad in commerce or economics. And 2 years at Goldman and or Morgan Stanley, whatever it may be. But
Yeah.
I think more than anything, it gives you a different perspective. That's certainly probably the easiest. Not easiest is the wrong word. Most traditional route to getting places. But however, if you go through our industry, I was just listening to another podcast on my way into work today with Barry Ritholtz and Bill Gross, and talking about how Bill Gross got started reading Ed Thorpe, who one of the most successful hedge fund managers of all time, but wrote a couple famous books, Beat the Dealer, about blackjack. So Bill Gross then went and counted cards in Lake Tahoe.
Did he really? Bill Gross?
Yeah, so, only for a few months, which is funny because fast forward to when I was in Lake Tahoe, learned enough how to count cards and did it and got kicked out of half a dozen casinos, but, did it more for just the sake that, okay, I know that it's beatable, I can do it, but I never had enough of a bankroll to make it more interesting than earning about minimum wage per hour, but it was fun nonetheless. But my point being is that you have people with these somewhat different backgrounds that end up in our world. So I often talk to people that come from all different walks of life, but you come up with a different perspective, and everyone's road. I would never trade, how I got to where I am for the world, all the difficulties and challenges, but it's been fun.
I've been reading this fascinating book called Smart Cuts, which is very different from a shortcut. Sometimes shortcuts require, cheating, for example, whereas Smart Cuts is all about creating value as you get from one point to another. And they actually said that within the book, the author, I forgot his name, it's like Shane something. He basically says that the average period of time that every president has been in political office prior to becoming president is 5 years, which is relatively short. You would think intuitively that every president would have to have, a lot of experience within, various different forms of political office prior to becoming president. But you've actually will hear that, they were doing things in business and so many different fields, academics prior to becoming presidents. And very similar to like the cheetah in the forest, for example, its ability to run is one thing, but its ability to change courses is its key strength while keeping that level of momentum. So it's probably about people that are able to maintain some momentum, switch lanes strategically in order to get into, whatever objective that they're trying to achieve. And if, the current president is he's a perfect example, right? He wasn't in political office that long, and he just built that momentum going into office, for better or for worse, basically. So I thought that was very retrospective to all of this. But going to this whole paper that you published, maybe you could tell us a little bit about it and why it became such a hit.
I actually didn't want to write a paper, had no interest in writing or publishing. I had enough of that already as in college. I was done with writing papers, but was going through one of the designations, and this was the Chartered Market Technician, which is sort of the technical analysis version of the CFA. And it's a 3-year program, and in the third year, you had a choice at the time between the typical test and writing a paper. And time was running out on the year, and they announced that they were closing the ability to write the papers requirement because they were getting too many crappy papers and didn't have the resources to read all of them. But I remember thinking at the time, well, I don't want to go memorize a lot of what I consider to be voodoo. A lot of technical analysis is very legitimate.
Yep.
There's a massive amount of academic support for momentum and trend and all sorts of other parts of TA, but a lot of it is also subjective and not grounded in what I would consider to be good science. So some of the curriculum in my mind was more subjective stories that weren't really, something I would ever use or want to use so anyway, I didn't want to take the test. Was the short story, and so I said, fine, I'll write a paper. I have to turn in an abstract by December 31st. So just typed up the most simple abstract I could ever think of, which was, applying a very simple trend following approach to a global allocation. So literally, in my mind, it was, how does the 200-day moving average work on a traditional global portfolio?
Right.
And the basic paper was such that, look, if you take a portfolio of assets, U.S. stocks, foreign stocks, bonds, real estate commodities, and overlay, in this case, it's monthly data. So I did a 10-month simple moving average, which equates roughly to a 200-day, which is what is the most famous sort of indicator in that community.
Yeah. For whatever reason, we don't know, but it is a popular one. Right?
It's probably chicken and egg. Once people started using it, then people started talking about it, and it became the standard.
Right.
But for good reason, because it actually works great. And pretty much in every market we've tested, it has the effect of, there's a common misconception that somehow trend following by itself really increases returns, but that's actually not the effect it has. The effect it has is it may increase returns, and in some markets it does increase returns quite a bit, particularly the more volatile markets. But what it really does is it's reducing volatility and drawdown. And so that works good on any one, works well on any one market in a binary fashion. So it works fine on U.S. stocks. It doesn't always work, but it works even better if you combine it into a portfolio of non-correlated assets. So this is a very simple example of a portfolio. And, we published it, but then 2008 happened, which was an environment where people hadn't really seen in the U.S. since the 1930s, where it was a deflationary style environment where all of the risk assets, so real estate and commodities in addition to equities, all went down. In some cases, equities were only 50-some%, but some of the commodities and real estate indices went down, I think, closer to 70 or more. People hadn't really seen that, and so it was an environment that a trend following approach worked incredibly well. And but that's something I could have published in 2010 on accident, or even back in 2002. But the timing was fortuitous. But it's a very simple approach that doesn't take a lot of effort. But I think what resonated with people is also a little bit of the behavioral explanations on why an approach like that works. And the truth is that markets that like a capital market like equities behave much differently in uptrends than in downtrends, and there's statistical reasons why you can point to, but it's very simple because the volatility explodes once markets have already been declining, and the reason being is that people behave differently when they're making money than when they're losing money.
Right.
And they use a different part of their brain, right? You're making money and you're beating your chest, you're checking your account balance every day, you're talking to your neighbor about how smart you are to buy a Tesla. You go buy a Tesla, you go buy a second house, you're thinking about vacations. It's a very different feeling than if you remember back to like an 2008. You're losing money, the world's ending, some of the oldest banks in the world are imploding, your neighbor who's had a job for 30 years all of a sudden is without work, you don't open your statements, you don't turn on CNBC, you have this very much flight response, and so the volatility explodes. So if you can just avoid some of those types of days and months, you can compound your returns at a higher level. So in general, trend following reduces volatility by about a third, often reduces drawdown by about half. But I think it was just an interesting paper, nothing new. I mean, look, CTAs, commodity trading advisors, trend following, they've been around since the 70s at least. So the material was nothing. It even goes back to Dow theory of the 1910. So there's nothing new about the theory, but it was just kind of a simple explanation, simple approach, and then became more relevant once the 08 and 09 happened.
I always found, in terms of like moving averages, because I spent a lot of time looking at this as well, the issue sometimes is that as you get to shorter time frames, I know you're using a longer time frame, but if you start to go into shorter time frames, then obviously you are playing a game in which you are trying to capture price volatility, either upwards or downwards, doesn't matter if you're long or short. But if you notice, I think you might have seen this too, is that moving averages tend to lag, right? Especially on short time frames when, say, an announcement by the Swiss central bank just, boom, destroys that whole moving average thesis based on some kind of like event-driven activity. So I always, in like what I discuss about in my book, is actually more about understanding the probabilities of being able to move to a particular direction, or how, what is the probability of a particular equity or index going up, say, 10 or 20 points on a given time period. So you quantify. What you're trying to do is you're quantifying and creating some kind of histogram of price activity. And just very similar to looking at a baseball card where you're looking at the statistics of the baseball player, at least you get a feel for what is considered the current normal over, a particular data set. And at least, like you said, it brings you, or it strives to bring you a little bit closer to, a more scientific method approach with, the ability to test and back test and keep things less ambiguous to some extent. It gets worse when people are using MACD stochastics, adjusting different time frames. Then, like you said, it's just completely almost deteriorates to some extent. I don't know what your thoughts are on that.
Yeah, I mean, no matter what the investing approach is, you have to be able to understand all possible outcomes and the pros and cons. So, for example, if you're a trend follower and used anything like the 200-day moving average or shorter going into the 1987 crash, you would have been out.
Right.
If you had used anything like the 200-day moving average or longer, you would have been long going into that crash. And that's a very different binary outcome of a position that just lost or gained. That's a career sort of position. If you're only trading one market, right? If you're trading 70 markets, it doesn't even matter. But just so people know, you can have the full realm of what's possible. Mm-hmm. So the people that were surprised by the Swiss franc and blew up their fund, my argument is that you had no business running a fund in the first place because you didn't understand the possibilities of what could happen, right? And just understanding and try to appreciate how much what has happened in the past in history. And so we give an example often where we say, look, and we talk a lot about valuations and looking at U.S. stock valuations, for example. Mm-hmm. Only difference, we're trading at, let's call it a long-term PE of around 27 now. Right. And being a science guy, a quant, all that says is that in general, your odds are getting worse, that you're going to have a normal historic return. I mean, in general, returns will be down probably around 4% nominal rather than the historical 9 or 10. And doesn't mean, though, you're not going to have a great year of returns. And so the difference, that ratio has been as high as 45 and as low as 5. Mm-hmm. And the only difference is what an individual is willing to pay, right? So both outcomes, while not equally probable, are possible. And so, like when we're talking about different systems, understanding the potential that U.S. stock market could either go up 80%, 90%, or down 80%, and that's happened in the past. Right. You have to prepare for that outcome. Only if it's a 0.001 possibility, it's something that you have to factor in the realm of what could happen.
What are your thoughts towards, and I know that the models need to take this into account in some shape or form, but what are your thoughts on intervention by central banks? Because effectively the markets that we're looking at this day and age is very different to some extent from the markets that you're grandmother was looking at, right? Because central banks are playing that much larger of a role for people that are doing valuation and they're utilizing, say, for example, the 10-year yield. That's augmented to some extent as well. So what do you think about this role? And it seems as if the responsibility of states, or I guess international organizations, the risk is slowly being pushed higher, right? It used to be just financial institutions, then it was central banks, and now we could be looking at like international banks having more responsibilities for all these sovereign countries to ensure that they don't default to some extent.
My comment on, the silliness or the brilliance of what central banks are doing or have been doing is that they've always been involved with markets, and there will always be distortions because they create policy. And it's a matter of understanding, is this time different of what they're doing, or is it simply that they're muddling and these are the effects they're going to have? And there's some times where you can look at it and there's a very clear structural break, and that will have ripple implications. And there's other times where it's just mostly noise. And that's one of the beauties of being a price-only type of analyst or having system, and trend following is an example of one. But at the same time, that's the beauty of it. If it's even, we could call it central bank influenced, or whether it's institutions and individuals around the world that are driving prices to go where they may. Who knows? We could debate that for years, but it's what creates the opportunity, right? It's what makes the markets not completely efficient, and you can have moves like oil going from 100 to 50 over the course of a few months, and that creates the opportunity for the traders, right? For money managers to add value. So if anything, I take the opposite tack, that it's probably, from an investor trader standpoint, it's a great thing that people are meddling with markets,
right?
But it's getting involved in the geopolitics is always tricky.
So when you take a look at maybe first and foremost, you could introduce the whole concept of like shareholder yield. I'll tell you about my bad experience with shareholder yield, at least as of last year. I was looking at the emerging markets wisdom tree product, right, which kind of filters out globally stocks that would be considered quote unquote cheap and are presenting significant shareholder yields. Having a lot of Russian companies, for example, and Chinese companies in its basket, I guess the follow-up question to what is shareholder yield and the wonders of shareholder yield, does it apply internationally? And I know the answer is going to be yes, but when states get involved, how does that affect it in some shape or form?
Shareholder yield is the concept for the readers that are listeners that it doesn't make any sense to just look at cash flow distributions through dividend yield, but rather it makes a lot more sense to include other ways they use their cash, such as buybacks, which is essentially the same thing as dividends, right, if the stock's trading at intrinsic value and ignoring taxes, et cetera. And then debt, you could talk about debt and what companies do with debt as well. But you could take a step back, and you're saying you're using somewhat of a valuation approach, and it doesn't even really matter what the value approach could be. It could be cash flow, it could be dividends, it could be price to earnings. And 2014 was very much a year where U.S. equities beat almost everything else in the world, and most of the foreign markets did very poorly. In valuation metrics in general, you could have a valuation metric that'll underperform the market, and this is the challenge with using a fundamental or really any active approach for 2, 3, 4, or 5 years in a row. Or even as long as a decade underperforming, a market cap or growth-weighted portfolio. So it's an approach that works great over long periods, but that's the challenge of value or any statistical sort of approach is that in any given year, it's not quite a coin flip, but it's not too far of a difference. And so 2014 was an example globally where if you invested in anything outside the U.S., with the exception of maybe India and a couple others, it was a really challenging year. And a lot of the cheap got cheaper, which
Right.
if you're a value investor is music to your ears because it means you're getting them for an even lower value. And a lot of the expensive got more expensive. 2013 was the exact opposite of that approach. 2013, the cheap countries did incredible and the expensive did poorly, although the U.S. was a rare exception. So at some point, almost all of the research we've done shows that buying expensive markets is not particularly a bright thing to do, and historically buying cheap ones works out over the long run. But cheap often is equivalent to downtrends. And my favorite setup is something that's cheap and going up, so a value market that is also going up, and that's not the state of the world today. Most of the really cheap stuff, the countries, the equity markets aren't going up. If anything, they're going down. And most of the momentum is in U.S. dollar-based assets. U.S. dollar, U.S. stocks, U.S. real estate, U.S. bonds had a lights-out year. U.S. real estate, U.S. bonds were, I think, both up over 30%. So at some point, that'll change and that'll revert. But yeah, in general, value metrics did fairly poorly last year.
We hope you enjoyed this mastermind session. If you'd like to contact Peter Pham or Phoenix Capital, please email info@phx-cap.com.